seen some ups and downs, haven't we, in the stock market, even in just the last month. And since that may be an important part of your retirement plan, Tristan Hasty-Grant with Waterstone Private Wealth Management is here to put everything in perspective. Good morning, Tristan.
Good morning, Dave.
So let's start with the basics. How does what we see on the stock market on the news relate to our investments? If we have 401k, Roth, IRAs, how does that relate to what we're seeing?
That's a great question. And the answer is it relates kind of. I mean, when people talk about the stock market, they're probably talking about the S&P 500.
The Dow.
Or the Dow Jones, right. And that's just a collection of stocks. So that's giving you more or less an average of how all these different big companies are doing.
Yeah, so if you are 401k, IRA, you have more sources. It's more of a portfolio.
That's right.
Than just the stock market.
That's right. It's like that's your specific subscription or your specific prescription in the stock market as a whole, but you aren't the stock market as a whole. You've got a very narrow portfolio.
Yeah, right. So let's talk about market volatility again. So what is market volatility? When we talk about that, what does that mean?
That's another really good question. Market volatility is just talking about the ups and downs in those indexes as a whole. And so the more volatility there is, the higher highs, the lower lows, and the faster we're swinging in between.
This graphic right here, the big black line, that is the Great Recession.
That's the Great Financial Crisis of 2008.
Right. So after that, we have seen a lot more volatile days. Tell me, more black means more volatile days?
Right, Dave. So as we look at this chart, the higher the bar, the more volatility we saw in that year.
This is like a 20% swing.
These are 20% plus days. So, and this is the volatility index, the VIX. So again, this is an average of the stock market and its volatility. But as you can simply see, to the right of the line, the bars are higher. We're seeing historically more volatility and larger volatility days than we ever have. And there's a lot of contributing factors to that. You know, algorithmic trading, AI, all those kinds of things which are making stock trades even faster, move the markets even faster.
So fewer human traders can contribute to...
There's more human participation, but those AIs and those algorithmic portfolios move quick.
Yeah. So you even put together a timeline, another one, and I love these charts. This is a historic timeline. We're talking about, this goes back 120 years to show what's the point of this graphic, because we're seeing every single world crisis you can think of, Suez Canal to the 100-Day War to the Great Financial Crisis and beyond. What is the point of this here?
Yeah, Dave, this here is the overall market, like we've talked about, and you're seeing some of the most awful headlines that we've ever experienced on this chart, specifically on the geopolitical front. So people remember the Cold War. People remember Black Monday back in the 80s, the tech bubble, 9/11, all these really awful times where it probably...
2 world wars.
Yeah, it probably felt like the end of the world. And, you know, those things are scary and they're real to be taken serious, but this chart just illustrates over time, the market always finds its way up. Not that it doesn't have down days, not that it doesn't have down years, but we've got to invest for the long haul.
So you believe this current market that we're in, describe what you're seing, and I mean, how long could this go?
Yeah, so, you know, if everybody's crystal ball worked, you know, I would be out of a job.
Right.
But I say that in jest, but we're still seeing a strong U.S. consumer, and we're still seeing a strong U.S. economy. And all that being said is the average bull market, which I think you have a graph of here, where, you know, historically, we're in a short bull market, which only means this positive market is young. The average bull market lasts 61 months, and we're currently at about 20 to 22 months into this bull market. So, you know, history isn't guarantee of returns, of course, but this is to say, from a historical perspective, there could be more legs under this thing.
The bull market that we're in is all the way to
the right.
Right, yeah. Right. And then we're talking about the 1990 bull market. That's 114 months. 2009, that's 131 months. That's when that lasted. So one more question. I couldn't let you go without asking about interest rates. Jerome Powell, the Federal Reserve Chair, says the time has come to cut interest rates. What is your read on this?
I think that's huge news. You know, we talked about this bull market being young, something that could really give relief to the U.S. economy, which is slowing, and that is, you know, important to point out, is that lower interest rates will help these large companies that we're investing in continue to do business in an efficient way. So, you know, for Jerome Powell to come out and say so definitively the time has come to have a change in policy, he hasn't done that in the better part of 24 months. And so, needless to say, the stock market is pricing in cuts, and so cuts in September will be important, but whether or not the Federal Reserve does 25 basis points or 50, who knows, but cuts will be important.
We will know what happens in September. So Tristan Hasty-Grant from Waterstone, thank you so much for your time.
Thanks for being here, Dave.